Hello and welcome to Sound Financial Bites. My name is Paul Adams, CEO of Sound Financial Group. With me today is Cory Shepherd, President of Sound Financial Group. Welcome to the...
Well, thanks for having me on. How many times do I have to be on before I'm not a guest anymore?
I don't know. Given that you're actually driving the conversation today, I don't know, but we're glad to have you anyway. One day you'll be glad to have me, and I won't. I'll be the guest.
I look forward to that day.
That's going to be exciting. So today's topic is talking about something that nearly everybody owns at some point in their life. Nearly everybody knows someone who has had something happen to them that prevented them from working, either sickness or injury, and that's disability insurance. And what gets skipped all too often is that people end up buying it either because it's a check box at work, like just for the group benefits, or somebody intersects in their life and sells them a policy. Mm-hmm. But rarely, if ever, do you find a place or a resource you can go to simply say, here are the things that you need to think about philosophically when acquiring disability insurance, and here are the contractual provisions you need to make sure are there if you can get them given your occupation. So that's our topic today, and Cory's made a bunch of notes and really thought through everything that we should hit. So with that, I think I'll hand it to you.
Great. Most of us do have some experience with disability insurance, whether we know it or not. We're all actively making a decision of omission or of action if we work for a corporation and we have group benefits. And I think that a lot of times the corporation's paying for it. We're actually not even paying for the disability at all, and we think that means it's all taken care of, when in fact those can be the situations where we're leaving the most gap on our balance sheet. So we're going to talk philosophically about why it's important, and then some things that you really need to know when you're reviewing this for yourself. The first is, for any client who has not yet significantly compiled a good amount of assets, and that's a doctor right out of school, any professional in their 30s and sometimes 40s, usually hasn't had the time at their income earning potential to develop a large balance sheet of a 401k or a investment account. Well, that means your income is the single biggest asset on your balance sheet. And I think, Paul, you have something for us to look at to start illustrating that.
Well, there's one thing I'd love to talk about before we get to it being the biggest asset on your balance sheet. And that is all of the stuff that could be available through your work that has nothing to do with actual long-term disability insurance, full protection. So let's start with why you'd protect yourself at all from anything. So what are our two rules, Cory? What are the two things that must happen to say, if you're going to protect yourself, these two criteria are how you judge to protect yourself or not?
Well, it's got to be catastrophic, and it's got to be infrequent, whatever thing we're protecting ourselves from. And we have a podcast that goes deeper into that. And but just for now, just think of it in terms of, we probably wouldn't ever get insurance on, say, breaking our dishes in our house, because it probably happens somewhat frequently, and it's not really a catastrophic loss if we break one of our plates for most of us. So we aren't going to insure something like that. But there is a reason why we're, by law, required to have car insurance, is that it happens often. People get in car accidents, but it's infrequent enough that we can actually have a corporation make an insurance policy around it, and it's catastrophic enough if it happens that we've got to protect.
Yes, and the third component is, if it's catastrophic, it's loss, then we had better protect its full replacement. Mm-hmm. And so catastrophic, full replacement, and of course it's got to be infrequent enough or no one will insure it. So at your work, oftentimes you'll see disability insurance, and once again say it's handled, but it may be one of two things. Short-term disability, meaning it's going to last you 6 months. Now, that doesn't meet our criteria of being catastrophic. A 6-month disability is awful, no question, but we should have enough money on our balance sheet to help weather that little bit. But it also needs to fully replace our income. So we're disabled for 5 years. Clearly, the 6 months of disability insurance doesn't cover that gap. So catastrophic, full replacement. The other thing that doesn't cover that are accidental disability plans.
Oh, yeah.
So you have all the things, cute duck, that tells you to get this coverage, and it saves the day for a bunch of people. And that could be true, but for the clients that we tend to work with, people between 300,000 and $1.5 million of income, those policies get little to nothing done, and they only pay in the case of accidents. So let's think about that for a moment. That means if I get hit by a car or if I die in a plane crash, my family gets properly and completely financially remunerated for anything that would happen to me. But if I die the way so everybody does,
Right.
statistically speaking, everybody dies of a sickness or injury or gets disabled due to a sickness or injury, not an accident, then my family is up a creek, literally without a paddle. That's why we call that gambling, not planning. That's pure speculation that what's going to take me down is that very unique niche thing, not something across the board, because what we're protecting is the income. We're not meaning to speculate that I'm going to be taken down by a rock climbing incident or a
Airplane crash.
accident. Yes. So those are two things just to keep in mind, even before we get into that. And so let's just cut over. I'm going to come back to this, what we call the pool of one gamble. All right, so let's take a look at somebody's actual balance sheet. Okay, here we have a family, and this is using a tool that we have that helps clients aggregate everything they have, both things they might have with us and things they would have anywhere else, to give the client full situational awareness and transparency about their money. But let's look. These people have an emergency fund, they have joint investments, not in a retirement plan, bunches of money in investments. You know, somebody in their mid-40s, they've even managed to acquire a vacation home. They've got a little bit of life insurance, reasonable mortgages, a little bit of credit cards they need to knock out. Not a big deal. Decent net worth, $1.8 million. Now, if I were to ask you, what is the most valuable thing this person has in terms of assets? People would regularly scan through here and go, maybe that Roth IRA because it's going to grow tax-free for the long run, or Frank's 401k, it's got several $100,000 in it. People change what they value, or they might say your home. Your home is the best asset. We have other videos on that. We don't think your primary residence is an asset. But right here is where people get really confused. And what they forget is their most valuable asset is not the capital in the 401k, but their human capital at work in the marketplace. So let's just take for this person, say they're making $350,000 a year. Mm-hmm. So can I put you on the spot and have you just grab a calculator?
Yeah.
And what we want to do is just take this person, say 38 years old. Let's just round it to 40, so it's a nice 25-year period, Cory, saying that they plan on exiting the workplace at age 65, and they're making $350,000 a year, and they never get a pay raise, for the sake of my example. They're doing good, and that's it. That's all the best they're going to do. What do we have in terms of total earnings over the lifetime, no inflation?
Yeah, so just the cash that's flowing through their paycheck over 25 years, $8.75 million.
$8.75 million. That really dwarfs
anything.
$1.8 million. It dwarfs nearly anything else you could have on your balance sheet. You are your most valuable asset. Not by a little, by a long shot. And yet, people never think for a second to do without homeowners insurance.
Right.
Even people who pay off their homes. In fact, I just asked a client the other day, I said, whose home is paid off, and we were in this conversation, and they said, disability insurance is kind of expensive. I think we have enough assets we could take the hit, and they got a couple, $3 million. And I said, well, can I just ask, you own your home outright. The odds of your home burning down are infinitesimal next to losing your income for over a 2-year period. Would you be comfortable if I told you, let's go ahead and stop paying for your homeowner's insurance because what's the likelihood it's going to happen?
The advances in fire retardant building materials have happened much faster than medical technology.
Yes, yeah, at least in terms of not. And the other problem is now we don't die.
Right.
When we get sick or injured, stuff that used to kill us 20 years ago, like we just keep limping along. Like there are insurance companies where actuaries have come out and said, we're not doing any more long-term care because people basically have stopped dying. Really good for our life insurance business. Really awful for any of our morbidity-based businesses like disability and long-term care. So that's first and foremost, most important. It's the most valuable thing we have. But I just leaned into a little bit, what are the odds? What are the statistics? How likely is this to happen? For those of you that have experienced our philosophy conversation or even looked at our some of our other YouTube videos, you're going to be familiar with this concept of the parachuter's paradox or the pool of one gamble. And it's this. In the real world, everywhere outside, and I don't want to say everywhere, but most everywhere outside of talking to us, this is the way we naturally relate to risk. If somebody says, well, what are the odds? Like, I'm a parachuter, I'm strapped to the jump instructor, and we're getting ready to jump out of the plane. And right before we do, I say, hey, what are the odds this doesn't work out? Like, hey, we're about to jump out. We're 13,000 feet. Looks like a long way. What are the odds this doesn't work out? He says, it's no big deal. Only 1 in 100,000 times does this not work out. Now, here's what your brain does, is what my brain naturally does, is we look at that risk, and what we mentally do is we spread the risk equally across all 100,000 and make it not that bad of an impact. Like 100,000 people jump out of an aircraft and everybody lands slightly harder. And as soon as I start saying that, your brain's already working ahead of me, but that's not how it works. How it really works is 99,999 of them land fine, and one of them makes like a dent in the planet. That is the pool of one gamble, because there's a 0% chance of you getting disabled. 0. It is not going to happen, especially if you're healthy enough that somebody would actually issue you a disability insurance policy. Right. The odds are as close to 0 as you could ever get, or they wouldn't give it to you. Unless it's 100%. You see, it's either 0% likely or 100% likely to you. If there's a pool of people, you're looking at 100,000 people, then you can make a judgment of likelihood. That's what the insurance company does. But to us as individual, catastrophic losses, what it takes is one time happening, and it's 100% likely.
It's kind of like the children's message I heard from my pastor once as a kid. The beach full of starfish, sea stars, drying out after the tide had gone out, and this little kid throwing a few back in, and the dad's like, it's not going to make any difference. There's so many out here. And the kid's like, it matters to this one, and throws it back in the water. Like, it matters to the person that the disability happens to, and it's, I love that.
100% happens to them or 0% happens to them. Mm-hmm. And that's more how we have to think about these risks. When we're looking at systemic risk on your balance sheet, what are the things that can interfere with everything? I want to say that again. What's the one thing that could jeopardize everything? And there might be more than one of those one things. We talk with clients as we're building the moat around their castle. That could be your will and trust. It could be having a proper umbrella policy. It may be having an appropriate disability insurance, or it may be a life insurance policy. But those are one things that could dismantle, jeopardize everything. And all we have to do is get them protected and protected properly. And by doing so, what do? We assure that our plan has the best chance of completing. The appropriate amount and structure of insurance has the opportunity to become assurance that our plans can complete. Okay. I want to do one more philosophical thing,
okay,
and then we could roll into part 2 where we dig more granularly into the contract, provisions, etc.
I'll allow it.
Very good. So consider this. If you get sued, okay, and somebody invades your balance sheet, what they're actually taking from you, realize it or not, is your time. Your time is what gets taken away from you. If you're 45 years old, you've been working in the marketplace for 25 years, you've accumulated $1 million of assets, and you get in a car accident and get sued. What happens? Your time that you've put in thus far is taken from you. If they garnish your wages out to the future time is being taken from you, not to mention time in the present and distraction, everything else it was to deal with a lawsuit like that, hire attorneys, wonder what's going to happen. Okay, time taken away. Same thing happens if you were to get disabled. Because what happens, all the time you put in, progressing your career to the point that you make the amount of income you make now, all of that gets taken away because now suddenly you can't do your career anymore. Maybe it's not permanent. Maybe it's just a couple of years. But here's what I have everybody think about. How many years, if you have 400,000 or 500,000 of investable assets on your balance sheet, how many years could you provide your current lifestyle before you wiped out everything you've done so far? I'm going to say that again. Let's say you're making $350 a year, and you're good. You're really good at saving money, setting money aside in your wealth coordination account, buying assets, but you still have a household that consumes $200,000 a year. Or with maybe you got as low as $150,000. $150,000 of consumption each year would wipe out a $400,000 or $500,000 balance sheet in a matter of 3 years. And that's if it's all investable. That didn't count like fire selling or real estate property, all that. Like it's bad. It wipes out everything you've done so far in a very short period of time. And it steals your future earning potential. That's what we're trying to do, is control these controllables with protection so that we can embrace and tilt. Like, you don't know what you're going to make the rest of your career, how you're going to position yourself for the next raise, or if you're a business owner, that next market expansion. You don't know exactly how all that's going to go. But there's certain things that we can know very clearly and do everything we can to bank on that economic certainty by controlling these controllables and giving ourselves enough time. Because if you save enough money and you don't make any radically speculative investments, all you have to have is enough time to produce the financial future you'd want that includes definite financial independence and being able to have a work optional lifestyle. All you have to have is enough time. So getting certain things done, putting the moat around your castle, is buying you the time necessary to make sure that your plans can come to fruition. So with that, Cory,
I want to hook on a positive note or places on a continuum. The question you asked was, how many years can you provide of lifestyle, right? So the person who retires with all the confidence in the world is doing that because they're answering that question with unlimited, like as many as I need.
Yes.
So disability insurance, your income, we're all on this continuum of how do we get your balance sheet to the spot where it can say, I'll give you all the years that you need. So it's all one conversation.
That's it.
It's all one. Yeah.
Yeah. It's all still making sure that you have the assets that you want to have for the future, to build the lifestyle that you want to have, so that you get a chance to design and build a good life. That's it. That's it. Cory, do you want to share with everybody where they can reach us, and then they can join us on next week for part 2?
Yes. So info@sfgwa.com or our website, soundfinancialgroup.com, sfgwa.com.
Connect with us on LinkedIn. Send us a note. Tell us what you'd like to see on future episodes. We'd love getting that from all of you. Or send us a note with something you learned in particular from this. If you want to have a conversation with us about our philosophy, we're always happy to do that. To any podcast listener, spend 30 minutes with you, share with you a little bit about how we look at money, and give you the opportunity, if you wanted, you could apply to become a client. Have a great day, and we hope this contributed to you being able to design and build a good life. And path versus the doctor that now comes out making $450. That doctor did not break even on the decision to go to medical school, counting all the years they were not earning. Plus, this is when Cory said it, you're not doing it for money, even if you think you are. When you count that now $500,000 of debt, they don't break even on the decision of having gone to med school for another 10 years. Meaning it's a 20-year path till it breaks even with the guy that's the okay business student now working his way through corporate America.
And we've seen doctors and dentists that have never broken even on that decision because of the lifestyle.
Because of the lifestyle, yes. And same with the business owner. The business owner that sacrificed for years and everybody's out earning him. I mean, I remember early on in my entrepreneurial journey, I literally at one point was like, maybe I should be a flagger at a construction site. Those guys make like $25 an hour. And all I got to do is make sure I don't get hit by a car, which doesn't seem that hard. I got an orange vest on. It'll be fine. I got to stand out in the hot sun. That was
listen to my Walkman all day.
Yeah, totally. Yeah. Back when there was a Walkman with the big, remember the foam things over years? That literally had gone through my mind, because those people, as I saw them holding flags, they were out earning me early on in my career. But that means that I went years without having the income that they had.
Right.
But then when I got to the other side of it, I needed to adjust. And we'll talk more about this, I'm sure, on a future podcast, but we went through this radical life simplification, choosing to live radically within our means. We reset our window a couple years ago. As a household, we decided we are not going to live that way. And we now fly total counterculture to what people say we should do, being, successful financial folks.
Yeah. So we are 6 months away from Danielle getting a paycheck for the first time in several years.
Woohoo.
Woohoo. And that's, so no matter how much money I'm making, which thank goodness that we're not a no income household.
Yeah.
I mean, that's a very big gift for both of us to be able to go through this journey together in that way. Doesn't 60, 70, 80, no, 50, 60, $70,000 that wasn't there before now coming in. That's still notable.
Notable, especially because you guys will actually be able to set it aside because you won't need it for income.
Correct. Because we haven't been living on it. So $60,000 a year that's there tomorrow that wasn't there today. I mean, you have to have a very high, even someone making multiple millions of dollars a year is financially astute enough to know what the value of that is. It's not an inconsequential decision. So I just got a new car. Now there's a whole other podcast on getting cars or how to get cars and what to do about that. But know that I spend a couple percent a year of my household income on a car. That's like very low.
Cars.
On cars. Right. And I don't drive one that has any kind of picture on the front that would make people exceptionally excited or think that I'm a wonderful person.
Yes.
And I'm keeping this a little bit vague, not because I don't want to share, but because comparison is the thief of all joy. Like I like to say.
I love that.
And so I'd rather keep it vague enough that you can just think about your numbers in your head and your situation without having to compare to mine.
Although there was a friend of yours that got a similar SUV that equipped similar size, everything else, and all the same features. And what was the purchase price difference between the two?
Double. He spent twice the amount of money as I did for now. My car doesn't have the same emblems, and maybe the leather's not quite as nice, and maybe the screen is not quite as fancy. I'll give him that. There's definitely a little bit more curb appeal, although for everything that I wanted, and this comes back to when we talk about how much is enough for retirement, get clear on what you want first.
Yes, before you go look, before Madison Avenue gets a hold of you, before the salesman gets a hold of you, pause long enough and say, what is my strategy?
Mm-hmm.
Like, what are the things what's sufficiency for me in a car?
Right.
Now, for some of us, like me, I'm like, I would like it to be a hybrid because I like the idea of getting high gas mileage. And that's 4 doors.
Right.
Like 4 doors, 4 wheels. I am super, like almost Spartan in that regard, where I don't trust the technology they put in the cars anyway, because my latest iPhone update is superior to any technology they designed to put in that car 2 years ago.
Mm-hmm.
But for you might be like, no, I want the in-dash navigation. I want Bluetooth.
You know what I love? When I sit in the driver's seat, floating out above the nose of the car is the speedometer. Like it's a heads up display. That was one of the cool. I love technology like that. My wife knows that I'm like that. And here's the reality is that I was probably going to do something like that anyway. It's not the cheapest way that I could own a car, but it is inside of my structure of our finances and what's going to work well for the future. And I do thank the Lord for Paul Adams being in my life every single day, because I am spending far less on the frivolous car purchase than I would have otherwise. Like the last car I got, I sheepishly sat down with him over a beer and said, this is what I'm thinking of doing. Do you think there's a problem? Because I didn't want to be outside of the realm of what we thought was acceptable for our culture of clients.
I was going to say, and even it was like we had built this culture where if somebody rolled up with a brand new car, like that they bought because they could afford the payments. Afford, by the way, is the begin. If you're thinking, can I afford something? It's the beginning of you're off in your strategy somewhere.
Yeah.
Because afford is a strategy of the people marketing things to you.
Mm-hmm.
But that you would actually be made fun of for buying a car that you could afford and not having a philosophy behind why you did it. And I remember there was a guy we hired who had an Audi A8. We were all like, what a joke that you would have an Audi A8 because it was literally all show, no go, all hat, no cattle. And And that's something that we have to watch for because nobody else in society cares if you're financially successful.
So I'm very proud of myself. A car that's 3 years newer than I had before, with a lot more features, with a couple freebies thrown in, and I'm paying less per month now. So that's actually a great rule of thumb. If you can I get a new car? If you can get a new car and pay less than you are now, go for it.
Yeah.
If you can do
Well, like for me, we have a new car purchase that I'm actually going to talk to Cory about after we're done recording today as a part of just one of my goals for the company this year is to be able to take out a certain amount of excess money because I want to be able to buy a Jeep as my daily driver that will also be the tow behind vehicle. But because it's a conversation I've been in for about 2 years and seeking advice and asking people, I found out is like the best to tow is a late 90s Jeep. Significantly lighter.
Yeah.
But as you might guess, way less expensive. And I can get a late 90s Jeep for a fraction of what would have been my default to first purchase. But went back through what is it I'm after, what's important, and one of my big restrictions on it was it needs to be quiet enough that I can talk while I'm driving. But now the Bluetooth technology is so good at noise canceling, I don't even have to solve that. The thing can be as noisy, it could be shaking apart as I go down the road. As long as it doesn't actually shake to pieces, it's a vehicle that'll work for me. And so as a part of our revenue goals for the year, this year is going to be me extracting enough money to pay for my Jeep. Cash. Yep. Which, by the way, most things you're going to get a really, really great deal on. You may want to be a couple of years old and be able to write a check for it. But another podcast for another day.
Yeah. So that's a car.
Yep.
So that's some thoughts on how to make that car decision.
Well, and people buy two of them.
Often buy two.
And then we have toys, vacations, and homes that all fall into that consumption that throws people out of their white coat window.
Right. Which we are making a splurge, and I'm taking Danielle to Italy as a celebration for finishing med school. Although we've been collecting miles for a good amount of time. So our round trip tickets for 2 to Europe cost us all of $360.
Nice.
Which is amazing. Yeah.
Well, and the thing to consider, whether it's the country club or whatever those things are, you have to put yourself in the position that if I'm going to consume X, one, what's the real cost? Second, being clear on, can I unwind this later? Like having a big splurge trip to celebrate a thing like that, like Danielle's finishing med school.
Right.
Big deal. That one only happens one time. When it becomes regular that quarterly we head to France for like that starts to become the kind of thing that if you stopped doing it, what do people say? Oh, everything okay?
Yeah.
So that's
right.
That's one of the things that's beautiful about if you properly monopolize, whether you're an entrepreneur, an executive that started making a lot more money recently, maybe a spouse wasn't working, now they're going back to work, so there's an extra big chunk of money. Being clear about what your window is, and then being able to set aside a great deal of money as a result of that window so that you don't get caught in the consumption cycle in additional lifestyle addiction that later has to be unwound. Because we've talked about on past podcasts, the more consumption you have, the higher amount of capital at work that's required to sustain the lifestyle that you're originally after. So you can't simply just say, I'm going to consume $400,000 a year. I'm only saving $40,000 of my $400,000 because that means the money has to be able to work $360,000 hard.
Right.
And how much easier it is if what you did is you had $200,000 a year. So anybody wants to go deeper on that, you can go to our YouTube channel, find Cash Flow Trump's Rate of Return. Has nothing to do with President Trump. Cash Flow Trump's Rate of Return. I really thought that one would get a lot more views post-Trump, just thinking people would like trip over it. No such luck.
No.
So
that was
parting thoughts?
Home, I would just say is the same. I mean, how long do we want to go on this? Because we could talk for these for years.
Well, speaking of that, I think one thing that people forget that's easy to trap physicians is the home loan programs they allow them to buy into. They don't even have a check yet. All they have is a contract.
And they'll get a mortgage. Yeah.
They'll get a mortgage for like 5 or no % down.
Right.
And literally up to 45% of gross income. Like it is amazing how people are perfectly willing to trap us in a lifestyle and do so for very, very long horizons of time in a way that may not be escapable.
And the thing I most wanted to say for the sake of time, because all the decision-making process is very similar to the car, like how you're going to balance that in your life. So just copy, paste that here too. But the American dream of home ownership, it feels like this thing that if you're not participating in this cycle, that you're not really an adult. A lot of people think of buying a home as their first adult thing to do. And I was that. I bought a condo right out of college. I have made that switch immediately. I had never been in the open rental market of Seattle until we sold our house at the end of 2016 as a part of simplifying life on this road show I went on with Danielle for all of her internships. And so
quick pause, but you talk about being financially responsible, living within your means, not being attached to the lifestyle addiction, being willing to sell his home meant that during the period of time when many people are separated from their spouse, Cory not only wasn't separated from his spouse, but he was able to travel with her and support her through that. So is that like an investment in your marriage, which is very different than what most people do in that phase. And what do you call them? Med school widows, med school.
Yeah.
So it's a thing.
It's a thing.
Yeah. So you guys have gone out of your way because of financial decisions allow you to invest deeper in your relationship and strengthen it during a time when it gets weaker for many people.
Yeah. And because you're moving so often during that period and they arrange housing for you, I did end up living in some places that someone could say, I don't need to live in this. But it made us appreciate more what we had and what our real priorities were, which is being together. And so now we have that choice. Like I've been a homeowner. I'm a home renter for the time being now. And I'll tell you, the cognitive load of not having to worry about all that is quite amazing. We're going to wait and see where we land with Danielle's journey before we make a choice about buying another piece of real estate. But it's not a sure thing that I'm just going to buy a house the moment that I know where I'm going to be living.
And think about that not collapsing. There's another example of the financial current people get swept up in is that what I'm going to do is just because I'm making enough income, I'm going to buy a house. When buying a house may or may not be the best possible financial decision you should be in. In fact, what I would encourage most of you to do is to look at your total cost of housing right now. If it's higher than 15% of your gross income, you need to be very, very worried. And you may need to make some lifestyle changes. I was at a conference where somebody was speaking, a financial guy who I like a lot was speaking, and somebody said, well, I can't keep it below 15%. Have you tried to buy a home in Southern California here? And he said, who says you get to buy? Like you might just have to rent. Maybe you don't make enough money to buy in this market.
Right.
And you could hear like the collective gasp in the room. Half of the gasp was how offensive you should say I shouldn't buy a home. And the other half was the release of, I don't have to buy a home. The people are burdened with buying a home. And for many people in many of the markets you might live in, it may not be the best decision to buy the home that you're going to live in. You might be much better off buying rental property, buying or renting a home and buying a rental property than the other way around. So
that's a great segue into, if people want to find out more about us, we have a new white paper called Money, Where Humanity and Hard Numbers Meet. And one of the things we talk about is how your home, if you're thinking of your home as an investment, how that actually interacts with the rest of your investment portfolio, which most people don't think about. So if you want to learn more about us, some of our basic philosophies, humanity.sfgwa.com. You can download that white paper, and that'll continue that conversation on home ownership. And then if you anything you've heard here is spurred on the desire to have a further conversation one-on-one, send an email to info@sfgwa.com and write the word philosophy in the subject line. That'll get you connected to us.
And what our hope is that this conversation today of why should we talk? Why we should talk.
Why we should talk.
WWST. Why we should talk on the White Coat Window is a contribution to you being able to do a better job of designing and building a good life. Hope you have a great rest of your week.